Welcome back to Accounting 102. In this video, we're going to cover Chapter 6, Cost Volume Profit Analysis, Additional Issues. It's less issues, I think, than additional things that you can do with it. So we're going to just build on what we did in Chapter 5, introducing cost volume profit, and seeing some different ways to apply it, and look at some examples that are more things that you might face when you're working. So our learning objectives are apply the basic CVP concepts, a little bit of review, explain the term sales mix and its effects on break-even sales, determine sales mix when a company has limited resources, and then indicate how operating leverage affects profitability. So as a review, CVP analysis is a study of effects of changes in cost and volume on a company's profit, important to profit planning, critical in management decisions such as determining product mix, maximizing use of production facilities, and setting selling prices. Again, review of what we did in Chapter 5. We'll go through a couple more examples just to make sure we're all on the same page again. So the CVP income statement. Management often wants the information reported in a special format income statement. This is for internal use only. Cost and expenses classifies as either fixed or variable. It reports contribution margin as a total amount and on a per unit basis. So here's an example of one for Vargo Electronics. We list our variable sales, which is cost of goods sold, some selling expenses typically, some administrative expenses could be variable as well. So we have total variable costs, and then we have our contribution margin. And then as you can see on the right side, we have it per unit. So sales, variable expenses, and contribution margin all per unit. And then the percent of sales. So we can get our contribution margin ratio, which in this case is 40%. Then we list our fixed costs, which could also be some manufacturing or cost of goods sold expenses, typically things that are in manufacturing overhead. Selling expenses and administrative are more fixed salaries and that type of thing, so it doesn't vary directly with the change in volume. And again, remember the net income that we show here will be the same net income as if we would do a GAAP income statement or a traditional income statement. So we're not adding or changing costs, we're just putting them in different line items and different categories within the income statement. So what we just looked at, we had total contribution margin of $320,000. Per unit is $200. So we can figure out what the break-even sales units are by taking our fixed costs, which was $200,000, divided by our contribution margin per unit, $200. And we see that it's 1,000 units to break even. Remember, breaking even is when our contribution margin equals our fixed costs. So we have zero net income. And then to get break-even point in sales dollars, we divide fixed cost by our contribution margin ratio. So that 40% is what our contribution margin ratio is. That's the contribution margin as a percent of sales. So if we do that division, our break-even point in sales dollars is 500,000. Target net income in units. So if we set a target income that we want to achieve, we can use the same formulas that we did for break-even sales units and break-even sales dollars to figure out how many units and what our sales dollars needs to be to break even or to achieve that target income. So in this case, if we're targeting $250,000 of income, We add that to our fixed costs of $200,000 and then divide by our unit contribution margin, just like we did for the break-even sales or break-even analysis to get the units. We see that we need 2,250 units of sales in order to achieve that $250,000 of profit. And again, if we want the sales in dollars, we take that fixed cost plus target net income, so the $200,000 fixed cost plus the $250,000 target net income, divided by our contribution margin ratio of 40%, and we get $1,125,000 sales dollars that we would need to achieve $250,000, our target net income. And the margin of safety, so in dollars, tells us how far sales can drop before the company will operate at a loss. It can be dollars or a ratio, so we're going to look at dollars first. So if we look at our expected or our actual sales, $800,000 in this example, we subtract our break-even sales, $500,000 that we just calculated a few slides ago. That means our margin of safety in dollars is $300,000. So as long as our sales don't drop more than $300,000 starting at our $800,000 of sales level, we will still operate at a profit. And then we can look at it as a ratio as well. So we take our margin of safety in dollars that we just calculated, 300,000, expected or actual sales of 800,000. So we divide that and we get a 37.5%, which that means is we said we could drop $300,000 and still make a profit. That means then the ratio is we can suffer a 37.5% loss and still break even. So as long as our sales loss is less than 37.5%, we will make a profit. So we can use the CVP and see what a change in the business environment will impact. So here's our original cell phone sales and cost data, $500 per unit selling price, $300 unit variable costs. That gives us our $200 contribution margin per unit, $200,000 of fixed costs, and our break-even sales that we just calculated was $500,000 or 1,000 units. So now if we look at a competitor is offering a 10% discount on the selling price of its cell phone, what effect will a 10% discount on selling price have on our income? So a $50 decrease, 10% of $500, have on our break-even point. We take our fixed cost divided by our now new unit contribution margin, which is $50 less, so 150. So we would need 1,333 units, so an additional 333 units of sales to still break even. So management invests in new robotic equipment that will lower the amount of direct labor required to make cell phones. Company estimates that total fixed costs will increase 30% and unit variable costs will decrease 30%. So what effect will this have on our break even? So our fixed costs are going up 30%, so $260,000 is $200,000 times 1.3. Unit contribution margin is $500 of sales minus our new variable cost of $210, which is 70% of our old $300. So that's where we got that $210 from. Our break-even sales in units is 897 units. So we would have to sell fewer units compared to 1,000 to break even now. Case 3, Fargo's principal supplier of raw materials has just announced a price increase. The higher cost is expected to increase the unit variable cost of cell phones by $25. Management decides that it does not want to increase the selling price of the cell phones. It plans a cost-cutting program that will save $17,500 in fixed costs per month. Fargo is currently realizing monthly net income of $80,000 on sales of 1,400 cell phones. What increase in units sold will be needed to maintain the same level of net income? Okay, very realistic scenario where you have current sales, you have current net income, you want to maintain that. You get a higher cost passed on from your vendor, whether it's due to inflation and higher costs, tariffs that we're facing now here in 2025 and 2026. That happened where I worked, is that we had tariffs, so we have an increase in cost that we need to figure out how to offset it and or pass that on to our customer. In this example, we don't want to pass it on to our customer, so how can we cut costs or increase sales? What do we need to do to maintain that? So our unit variable costs increased to $325. That's our current $300 plus $25 increase. Our fixed costs are reduced $17,500, so they're down to $182,500. Our new contribution margin is our sales, $500 that we don't want to change, minus our new variable costs, $325, so only $175. So we get our break even. Again, it's fixed cost plus target net income. So our $182,500 plus our $80,000 target divided by our unit contribution margin, and we get 1,500 units that we need to sell in order to keep our same income, $80,000. So we had increase in variable costs. We cut some fixed costs to offset it. We're not changing our selling price. In this case, we need to sell 100 units more than we're currently selling to maintain the same net income level. If we cannot sell those extra 100 units, our net income will go down. In a review question, Croc Catcher calculates its contribution margin to be less than zero. Which statement is true? Its fixed costs are less than the unit variable cost. Its profit are greater than its total cost. The company should sell more units. Its selling price is less than its variable costs. Its selling price is less than its variable costs. So remember, contribution margin, selling price minus variable costs. So we're just talking, if we're at a loss at contribution margin, we're not looking at fixed costs, we're not looking at total income, just that contribution margin. It's the difference between selling price and variable costs. I'll go through another analysis. Christine Company reports the following operating results for the month of June. So we have our CVP income statement. We had sales of 5,000 units, $300,000, $60 per unit. Variable costs, $180,000, $36 per unit, which gives us contribution margin of $120,000, $24 per unit. $100,000 of fixed expenses, so it gives us net income of $20,000. To increase net income, management is considering reducing the selling price by 10% with no changes to unit variable cost or fixed costs. Management is confident that this change will increase unit sales by 25%. Okay, so reducing selling price by 10%, increasing unit sales by 25%. Do Using the contribution margin technique, compute the break-even point in sales units and sales dollars and margin of safety dollars, assuming no changes to sales price or costs. So our break-even point is 4,167 units, which is $100,000 of fixed costs divided by $24 of contribution margin per unit. So that's existing. If we go back here, that's how we calculated that $24 per unit contribution margin and fixed expenses of $100,000. Okay. Break-even point in sales dollars, $250,000. So $100,000 fixed cost divided by 40%, which is our contribution margin ratio, $24 of contribution margin per unit divided by $60 of sales price per unit. And our margin of safety in dollars is $50,000. So that's $300,000 of actual sales minus our $250,000 of break-even sales. Now compute the break-even point in sales units and sales dollars and margin of safety in dollars, assuming changes to sales price and volume as described. So again, a 10% decrease in selling price and a 25% increase in sales units. So break-even point, it's our fixed cost, $100,000, divided by our contribution margin. So we recalculate that. So the $60 existing sales price minus 10% of that, or $6, minus $36 of variable costs, which doesn't change, gives us $18 per unit contribution margin. So 5,556 units is our break-even point in units. In dollars, it's that same fixed costs, $100,000, divided by the contribution margin ratio, which in this case now is the contribution margin per unit, $18 that we just calculated, divided by the selling price, which is now the new selling price, $54. We get $300,000, our break-even point in sales dollars. And our margin of safety is $37,500. So the $337,500 of expected sales. So after our changes, so 5,000 units plus 25% increase, so 25% times 5,000, that gives us 6,250 units. Take those units times the new selling price of $54, we get $337,500 is our sales that we're expecting after we implement these changes, minus our new break-even sales of $300,000. So $37,500 is our safety margin. So you can see how the changes happen between break-even and in units and dollars and our margin of safety when we implement different changes. So we can compare the two and say, is it worth that risk, or does it give us what we were expecting to achieve? So now we'll talk about sales mix and its effect on break-even. So sales mix is the relative percentage in which a company sells its products. If a company unit sales are 80% printers and 20% PCs, its sales mix is 80% to 20%. So it's whatever you're selling, just that combination. So it's the number of units of each type of product divided by the total units sold. That's how we get our percentages, 80 and 20. Sales mix always adds up to 100% because that's 100% of your sales. So the sales mix is important because different products often have different contribution margins. Companies can compute break-even sales for a mix of two or more products by determining the weighted average unit contribution margin of all the products. So Vargo, we're not only selling cell phones, but high definition TVs as well. Sell its two products in the following amounts: 1,500 cell phones, 500 TVs. So we have 200 units being sold in total. We get the mix by taking the units sold for that product. So cell phones, we sell 1,500. 1,500 of 2 divided by 2,000 gives us 75%. So we're 75% cell phones. TVs, since we only have two products, it's going to be the remaining 25%, but we can also calculate it by 500 TVs sold divided by total units sold of 2,000, 25%. Now we have some additional information related to the TVs. Cell phones we already knew, $500 selling price, $300 variable cost, $200 variable or $200 contribution margin. TVs, $1,000 selling price, $500 is our variable cost, so $500 contribution margin. Sales mix that we just calculated, 75% cell phone, 25% TVs. And now our fixed costs are $275,000. So to get weighted average contribution margin, we're going to take the unit contribution margin for each product individually times the sales mix percentage for that product. Then we add those together to get the weighted average. So cell phones, 75% sales mix, $200 unit contribution, so 200 times 75%, plus TVs, $500 unit contribution margin times 25% sales mix. We get our weighted average unit contribution margin of $275. So it's just doing that math and adding them together. Then we compute the break-even point in sales units by dividing the fixed cost by the weighted average unit contribution margin. So our fixed cost of $275,000 divided by $275 of our contribution margin on a weighted average basis says that we break even at 1,000 units. So remember, that's total units. So then we have to figure out how many cell phones and how many TVs we need to sell. So we use our sales mix percentage, 75-25 cell phones to TVs. So 750 cell phones, 250 TVs. If we sell at that level in that combination, the total contribution margin will equal a fixed cost of $275,000. And here's the proof of that. 750 cell phones sold, $200 contribution margin gives us $150,000 contribution margin. TVs, 250 units, $500 unit contribution margin gives us a total contribution margin of $125,000 for TVs. If we add the 150 and the 125 together, we get the 275. We add the unit sales together, we have our $1,000 of unit sales. Our fixed costs were 275, so when our contribution margin equals our fixed costs, we're at break even. So break even sales in dollars works well if a company has many products. Calculates break even point in terms of sales dollars for divisions, product lines, not individual products. So if we have different divisions we want to analyze or different product lines that we're analyzing, break even sales in dollars. So here's Gale Garden Supply Company with two divisions. We have indoor plant division on the left, outdoor plant division in the middle, and then the company total on the right. So we're just looking at the top part of that CVP income statement, the sales minus variable cost to get contribution margin. So in the indoor plant division, we have $80,000 contribution margin on $200,000 of sales. Our contribution margin is 40% for indoor. Outdoor, $240,000 contribution margin on $800,000 of sales. It's a 30% contribution margin. And then combined, $1 million of sales, $320,000 of contribution margin, 32%. Our sales mix percentage using dollars instead of units. So we can do the same thing that we did for units to get the percentage of the total. In this case, we're using sales dollars instead of units. So the division sales, so indoor plant, $200,000 of sales divided by the total sales in dollars, $1 million. So we have 20%. The outdoor plant is the remaining, since we only have two divisions, 80%, and it's $800,000 divided by the $1 million. Then to get the contribution margin ratio, it's contribution margin divided by sales. So we had indoor plant 80,000 divided by 200,000, it's 40%. Outdoor $240,000 divided by 800,000 is 30. And then we recalculate on a company total the $320,000 contribution margin divided by $1 million in sales, 32%. To get the weighted average contribution margin, we can take our contribution margin ratio by division, the 40% for indoor, 30% for outdoor, multiply that by our sales mix percentage, and add those together, and we get our 32%. So if we didn't do the full income statement for both divisions to contribution margin and add them across like we saw on the previous slide, if we know the sales mix and the contribution margin ratio, we can calculate the weighted average contribution margin ratio this way. To calculate break-even point in sales dollars, we take our fixed costs divided by our contribution margin ratio. So it's that same formula, but now we're using our weighted average contribution margin ratio, 32%. So break-even point in sales dollars, 937,500. So now that we know the break-even point in sales dollars, we know our sales mix, we know that we must sell 187,500 from the indoor plant division. We must sell $750,000 from the outdoor plant division. So we're just taking that total break-even sales and multiplying it by the sales mix percentages to get those breakout. If sales mix becomes 50 to 50, so we're increasing our indoor, decreasing our outdoor plant, the weighted average contribution margin ratio changes to 35%, resulting in a lower break-even point of $857,143. So $40,000 or $80,000 less sales, roughly, because we're selling more from the indoor plant division than we did from the outdoor plant. Review question. Net income will be A, greater if more higher contribution margin units are sold than lower contribution margin units. Greater if more lower contribution margin units are sold than higher contribution margin units. Equal as long as total sales remain equal regardless of which products are sold. Or unaffected by the change in the mix of products sold. And the answer is A. It's greater if more higher contribution margin units are sold than lower contribution margin units. So if we have a higher contribution margin, we sell more of those, we're going to have higher net income. Let's do another sales mix break-even analysis. Bicycle International produces and sells 3 different types of mountain bikes. Information regarding the 3 models are shown below. So we have Pro, Intermediate, and Standard. We have the units sold of each of those and the total, selling price per unit for each of those, and the variable cost per unit for each of those. Company's total fixed cost to produce the bicycles are $7,500,000. So now we've got 3 products instead of the 2 divisions or 2 products that we've seen before, but we can go through the same steps to calculate the sales mix and contribution margins and that type of thing. So we'll start with sales mix using units sold. What's the sales mix? We take the units sold for each product, Pro, Intermediate, and Standard, divided by the total. So the Pro is 12.5%, 5,000 divided by 40. Intermediate, 10,000 divided by 40 is 25%. And Standard, 25,000 divided by 4,000, 62.5%. And again, the percentages equal 100%. You have to make sure that they equal 100% because you're accounting for 100% of your units sold. Now determine the weighted average contribution margin. Okay. So if we take the contribution margin for each product, so the selling price minus variable cost gives us our unit contribution margin, and we multiply that by our sales mix percentage that we just calculated, add those up, we'll get our total unit contribution margin on a weighted average basis for the company. And it looks like this. So 800 minus 500 for the Pro times 12.5%, 500 minus 300 for Intermediate times 25%, and then 350 minus 250 times 62.5% for the Standard. Add those together, we get $150 contribution margin. That's our weighted average unit contribution margin for the company. Now that we have that, we can get the break-even units. So how many units do we need to sell? We take our fixed costs divided by our contribution margin per unit. That is our $7,500,000 of fixed cost divided by our 150 weighted average unit contribution margin that we just calculated. So 50,000 units that we need to sell in order to break even, which is more than our 40,000 that we're showing. Now that we have the total units needed to break even, we can determine the units of each model that the company must sell to break even. So we take simply our unit break even, 50,000 units that we just calculated, times the sales mix percentage. So we see that we need to sell 6,250 units of the Pro, 12,500 units of Intermediate, 31,250 units of the Standard. Now you may have noticed as we have gone through these examples, one of the assumptions we talked about in Chapter 5 was that we are assuming that the sales mix stays constant. So as we're going through these analyses, we're keeping the sales mix constant. That is another variable that you can introduce as you're doing some analysis, but then it gets a little bit more complicated and a little bit more in-depth analysis that is needed that we're not covering in this class, but just be aware that is the assumption that we're taking. And as you're doing the homework and doing the exam and quizzes and the projects, you can make that assumption, and that sales mix won't change. So once you calculate that percentage, it's going to be the same for all your analysis. Now determine a sales mix when a company has limited resources. All companies have limited resources. It could be floor space, raw materials, direct labor hours, etc. This could be all kinds of different limited resources that you're dealing with. Management must decide which products to sell in order to maximize net income. So Vargo manufactures the cell phones and TVs. Machine capacity is limited to 3,600 hours per month. Okay, so that's our limited resource that we're going to deal with, the number of machine hours available per month. So if we look at the cell phones and the TVs, we have our unit contribution margin of each, 200 for the cell phones, 500 for the TVs. Machine hours required per unit is 0.2 hours for the cell phones, 0.625 for the TVs. So the TV takes more machine hours to manufacture than a cell phone does. So we can calculate the contribution margin per unit of limited resource. We take our contribution margin per unit by product divided by the limited resource, in this case machine hours required. So the contribution margin per unit of limited resource is $1,000 for cell phones, $800 for TVs. This would suggest that given sufficient demand for cell phones, they should shift the sales mix to produce more cell phones or increase machine capacity. So if we look at this a little bit, if we just looked at the unit contribution margin, we would say, well, we should produce more TVs because it's got a higher unit contribution margin. If we have our same fixed costs, we're going to get a higher net income for each unit of TV, each TV we sell over selling a cell phone. So we should shift that way. But if we now introduce our limited resource of machine hours and how much each takes per machine hour that we have, which is our limited resource, we should be making more cell phones because that has a higher contribution margin per unit of limited resource. So you need to really take in different data and different constraints, in this case our machine hours, in order to make the correct decision. Constraints. This approach is used to identify and manage constraints as to maximize the contribution margin given the constraint. The company must continually identify its constraints and find ways to reduce or eliminate them where appropriate. So a review question. If the unit contribution margin is $15 and it takes 3 machine hours to produce the unit, the contribution margin per unit of limited resource is $25, $5, $4, or we don't have the correct answer. The answer is $5. We get that by taking the contribution margin of $15 divided by the limited resource of 3 machine hours to get $5 per machine hour is our contribution margin. Let's go through another example. Carolina Corporation manufactures and sells 3 different types of high-quality sealed ball bearings for mountain bike wheels. The bearings vary in terms of their quality specifications, primarily with respect to their smoothness and roundness. They are referred to as fine, extra fine, and superfine bearings. Machine time is limited. More machine time is required to manufacture the extra fine and superfine bearings. Now we have some information here. Our selling price per unit for each product, variable costs and expenses for each product per unit. We get our contribution margin per unit and the machine hours required. So the first question is, what is the contribution margin per unit of limited resource for each type of bearing? So remember, it's a unit contribution margin divided by the limited resource consumed per unit. So what we're taking the machine hours. If we do that calculation, we get $100 for the fine. It's the $2 contribution margin divided by 0.02 machine hours. $87.50 for the extra fine. $3.50 contribution margin divided by the machine hours of 0.04. And the super fine, $5 contribution divided by, slide says 0.8, it should be 0.08, sorry about that, $62.50. So because the contribution margins aren't significantly different, $2, $3.50, and $5, but the machine hours are 0.02, double the 0.04 for extra fine, double again to 0.08 for super fine. The fine has a higher contribution margin per limited resource. Now we'll indicate how operating leverage affects profitability. So cost structure is the relative proportion of fixed versus variable costs that a company incurs. It may have significant effect on profitability. A company must carefully consider its cost structure. So back to Vargo Electronics and one of its competitors, New Wave Company, both make consumer electronics. Vargo uses a traditional labor-intensive manufacturing process. New Wave has invested in a completely automated system. Factory employees are involved only in setting up, adjusting, and maintaining the machinery. So let's look at our cost volume profit income statement for the two companies. So we're taking this and comparing two companies instead of looking at changes for one. So we have our sales, our variable cost, contribution margin. For Vargo, $320,000 of contribution margin is 40% of their $800,000 sales. New Wave, same level of sales of $800,000, but their contribution margin is 80%, double what Vargo is at $640,000. New Wave has significantly higher fixed costs, so $320,000 more than Vargo at $520,000 versus Vargo at $200,000, gives us the same net income. So we have the same sales, same net income, different contribution margins. So let's look at some analysis we can do. We looked at the contribution margin ratio again on that CVP income statement, 40% for Vargo, double that at 80% for New Wave. So 80 cents of contribution margin for each dollar of increased sales for New Wave, while Vargo is only 40 cents. New Wave's cost structure, which relies on fixed costs, is more sensitive to changes in sales revenue. So it means that each increase gives you more profit, but also each decrease dollar is going to give you that much less in contribution margin and net income. So it's sensitive both ways. Now if we look at break even, fixed cost divided by contribution margin. So Vargo, $200,000 fixed cost divided by 40% contribution margin gives us $500,000 in break-even sales. New Wave, 520,000, so significantly more fixed costs. They do have a higher contribution margin at 80%, but that still gives us a higher break-even point in sales dollars of $650,000. So Vargo has to sell, or New Wave has to sell $150,000 more than Vargo Electronics in order to break even. Because of the greater break-even sales required, New Wave is riskier company than Vargo. So we'd say it's riskier because they have to sell more, and then they're also looking at if they lost sales, they would get negatives quicker. So if we look at safety margin, which gives us that, actual sales minus break-even sales divided by actual sales, the margin of safety ratio is 38% for Vargo, 19% for New Wave. The difference in ratios reflect the difference in risk between New Wave and Vargo. Vargo can sustain a 38% decline in sales before operating at a loss versus only 19% decline for New Wave. Okay, so the higher the safety margin ratio, the higher we get, the safer we are, the lower we are, the more risky we are. So we're using that percentage to compare two different companies. Operating leverage. The extent that net income reacts to a given change in sales. Higher fixed costs relative to variable costs cause a company to have higher operating leverage. When sales revenues are increasing, higher operating leverage means that profits will increase rapidly. However, when sales revenues are declining, too much operating leverage can have devastating consequences. So you're happier on the upside, you get closer to zero more quickly on the downside. Degree of operating leverage provides a measure of a company's earnings volatility and computed by dividing the contribution margin by net income. So for our two companies, we take our contribution margin divided by our net income, and we get our degree of operating leverage. So if Vargo ends up with 2.6%, New Wave is at 5.33. The higher the number, the more volatile you are, and the more net income changes with a dollar change in sales. So review question. The degree of operating leverage can be computed by dividing contribution margin by net income. Provides a measure of the company's earnings volatility. Affects a company's break-even, or all of the above. And the answer is all of the above. Let's walk through another example. So Rexfield Corporation, a company specializing in crime scene investigations, is contemplating an investment in automated mass can't talk today, sorry about that. Automated mass spectrometers. Its current process relies on a high number of lab technicians. The new equipment would employ a computerized expert system. The company's CEO has requested a comparison of the old technology versus the new technology. The accounting department has prepared the following CVP income statements for use in your analysis. So we're looking at the change in equipment, old versus new. We have same sales in both situations. The old, we have higher variable costs than the new, so 1.4 million versus 600,000. Contribution margin is reflective. Fixed costs are lower at 400,000 compared to 1.2 million under the new, and we have the same net income. So compute the degree of operating leverage. So again, contribution margin divided by net income is our operating leverage. Under the old, $600,000 of contribution margin divided by $200,000 of net income gives us a degree of operating leverage of 3. Under the new scenario, $1.4 million of contribution margin divided by net income of $200,000 gives us a degree of operating leverage of 7. It's over twice what the operating leverage was under the old. Okay, so it's much riskier in terms of operating leverage to go with the new scenario because of our higher fixed costs. A dollar drop in sales is going to give us a bigger loss on net income than a dollar loss under the old scenario. Okay, that's it for Chapter 6. Continue working on your homework. I did post some challenge exercises as well for Chapter 6 that you can attempt. I will post at a later time the solutions for that, but take a chance or take a look at that and try to attempt it on your own before you look at the solutions. As always, if you have questions or need help, please reach out. Thank you.